Very warm welcome and good evening to all of you. On behalf of Indo-American Chamber of Commerce Karnataka chapter, it is my pleasure to welcome you all to today's insightful webinar on navigating US M&A transactions, choosing the right acquisition structure. We are delighted to organize this webinar in association with our knowledge partner, Grant Thornton Bharat LLP, one of India's leading. We sincerely thank the Grant Thornton Bharat team for partnering with us to bring this important knowledge sharing session to our members and guests. As businesses increasingly explore investment opportunities in the United States, understanding the tax, legal, and commercial implications of mergers and acquisitions has become more important than ever. Today's webinar has designed to provide practical insights into US acquisition structures and the key considerations that can significantly influence transaction outcomes. To formally commence today's program, it is my privilege to invite our chairman, Mr. Gerald Manoharan, to deliver the welcome address and opening remarks. Jerry is a corporate commercial lawyer with over 25 years of experience advising clients on investments, restructuring, mergers and acquisitions, corporate compliance, real estate transactions, and employment matters. His expertise include entity setup, structuring, contracting, labor compliance, workforce restructuring, and managing complex workplace issues. As a transactional lawyer, he has advised promoters and investors on strategic investments and ownership models, including earnout, staggered transfers, overseas holding structures, and equity incentive plans. Jerry has also built a strong real estate practice involving land aggregation, title verification, joint development agreements, and many such. Based in Bengaluru, he is also serving on the boards of multiple non-profit organizations. And with his presence as a chairman of Indo-American Chamber of Commerce of Karnataka chapter, he helps us business between India and US. Jerry, the virtual floor is yours.
Thank you so much, Amrita. Good evening to all our participants today. We have a fairly full house, I should say, and it's a happy to note that despite it being midweek, we still have a fairly large participation, and it's obvious that the topic for this evening is going to be very invigorating and very involved as well. So I would like to thank GT Bharat for taking the initiative of putting together this knowledge session on a very topical kind of discussion, because a lot of Indian companies, directly or through their subsidiaries in the US, are constantly trying to find good structures to acquire US entities in a tax-friendly manner, in a manner that does not beat away and eat away into their foreign exchange treasury reserves here in the country. And therefore, I think it is important that these models will help us to have a very early stage approach on how to deal with prospective discussions on transactions that are brewing within the US soil. So while I understand that this presentation may not very specifically deal with overseas direct investment into US entities, I think the topic and the focus of today and the specialists who are here on this panel today are people who are going to almost transport you into the US regulatory regime, and to be able to therefore guide you through what are those specific things that you will need to keep in mind, especially when you're sitting on the table for a very preliminary conversation of a possible acquisition. Is it an asset sale? Is it a stock sale? What are the good ways to structure a transaction in the US so that you get the benefit of a quick acquisition, faster transition, and also at the same time you save cost in the process. So without taking any more time as part of this introductory address, I would like to now hand over the floor to Shrenik, Prathamesh, and Shashank to drive this conversation and to keep us all engaged in this very exciting topic and discussion, which I'm looking forward to hearing.
Thank you so much, Jerry, for that wonderful introduction and encouraging words. As Jerry mentioned, that we have the experts amongst us from GT Bharat. So we are privileged to have with us the three distinguished experts, Mr. Shashank Jain, Mr. Shrenik Kotak, and Mr. Prathamesh. Mr. Shashank Jain is the partner US tax for Grant Thornton Bharat. He leads the West India US tax practice Grant Thornton of Bharat, a qualified chartered accountant with over 15 years of professional experience, including 10 years in US tax. He specializes in US corporate tax advisory, business restructuring, transaction structuring, federal and state tax matters. He advises clients on domestic and cross-border reorganizations, tax efficient operating models, tax controversy matters, and pre-immigration and estate planning for high net worth individuals. He also has extensive experience managing US tax compliance for corporations, venture capital, and private equity funds across the technology, telecommunication, manufacturing, and financial service sectors. Shashank, thank you so much for joining with us today. Mr. Shrenik Kotak, who's also one of the directors of US Tax at Grant Thornton Bharat and leads the South India US Tax of Grant Thornton. He's also a chartered accountant and US CPA. He has over 15 years of professional experience, including 11 years in US tax. He specializes in US corporate and partnership tax advisory, transaction structuring, due diligence, and compliance. He has extensive experience working with startups and growth stage companies, helping them navigate US tax requirements through practical end-to-end advisory and compliance solutions. He also advises the US operations of several listed Indian companies on tax planning, due diligence, compliance, and other cross-border tax matters. Shrenik, a very warm welcome and thank you for joining us today. Prathamesh, who's also one of the directors of US Tax, he is based in Mumbai and leads the corporate advisory practice in US Tax at Grant Thornton Bharat. He specializes in US corporate tax advisory and due diligence with over 10 years of focused experience in US taxation. He has worked extensively with Indian businesses, helping them structure, establish the scale and scale their US operations in a tax efficient manner. His expertise spans US tax and regulatory compliance, cross border restructuring, transaction due diligence, ESOP planning, and international tax advisory. Prathamesh, a very warm welcome to you too. Well, would have not used the word US tax so much in my life, the amount I used in just introducing you three. So I feel that we have the absolutely the correct the speakers and the experts with us today. So Shashank, I'll hand over the floor to you now. Thank you so much for joining us, everybody.
Well, thank you, Amrita. Thank you, Jerry, for the welcome. And good morning to the folks who has joined us from the Americas region. So, can we have a PPT, please? Thank you. So before we, of course, get into any technical discussion, we like to just set the context of today. Uh, Before any M&A transaction is being looked into, everybody talks about the valuation or synergies which the overall transaction it will drive. However, the very often question has been asked whether any deal consequences would have an effect on tax or not. Well, definitely yes. So today we are going to look at what are the type of acquisition structure which a person can look when they are looking for a target. How tax deferred transactions and elections can be made to treat certain stock acquisition as an asset acquisition. What about those deemed asset acquisition rules? And what are the transaction risk which lies in a certain due diligence when we did due to the diligence? And then what are the risks we carry in a failed transaction? Typically, we have seen as per our practical experience. And lastly, how we are going to cover basis our expertise in during the diligence which we have done, whether are those failed structures are really talking about the tax or whether there are issues about the EBITDA or there are issues about the financial concerns. But most transactions don't drive through a valuation or EBITDA, but the real fight then comes to the tax structuring. Next slide, please. Well, before we get into the any dynamics of how these elections can be taken care, it certainly needs expertise to understand that what type of entities which are available in US tax. Now, there are sole proprietorship, C Corp, partnership, LLC, S Corp branch. Now, typically, C Corp is of course taxed as it is as a separate taxpayer. However, partnership, LLC, they get taxed at owner's level, meaning these entities are pass through from US tax purposes, which is completely different from an Indian context where our Indian LLPs or certain partnerships in Indian context are taxed at corporate level itself. And hence it doesn't matter whether what kind of taxation we are looking. But from a US tax perspective, the pass-through status is important because that drives that a certain transaction which you have done or have acquired an entity, which could be a partnership or LLC or it could be a sole proprietors, could change the tax structure itself and the financial reporting and the tax consequences as well. Next slide, please. So preliminary, I think what we are going to look at is that how a structure drives the tax results. Now, whether it could be an asset or a stock purchase or a reorganizing the structure before the acquisition even happens can produce a different tax basis for different taxpayers. Buyer and seller in the same transaction can have a different tax basis depending upon what kind of structure we are choosing. Various organized legal structures like as stock purchase or asset purchase, we can actually change the stock purchase into an asset purchase by making certain elections under 338H10 or 336E. Incentives differs depending on the transaction we are doing. The buyer and seller can have a different incentive depending upon what kind of step up basis they are getting and what kind of protection they are getting while choosing those elections. Now, of course, seller would bring the capital gain treatment first and the buyer would want the step up basis available. However, the election could change that as well. In terms of the international deal where there's a cross-border transaction happening, especially section 367 360 is of key importance because it could completely change the way that transaction is happening. Lastly, diligence takes place and it protects the overall value. It determines your annual limitations, basis carryover, any transfer pricing matter, state nexus, etc., which is really important while you're closing the deal. Valuation can be closed, however, the tax structuring could ultimately lead the way how the deal has to be closed. Next slide. Now, typically, we have talked about how structures are there in M&A. It's typically the asset acquisition, stock acquisition, and tax deferred reorganization. Now, typically in any asset acquisitions, you get the fair market value basis step up, and target may continue to liquidate post or it can not continue. It depends on the seller choice. Tax attribute generally remains with the seller. It depends upon what kind of elections we have done or it's a default asset acquisition or not. Certain operational transfer may also be required. However, in case of a stock purchase, everything remains with the buyer. Everything gets transferred, tax attributes, annual limitation application, etc. And also any credits which are available, for example, research and development credits, can be passed on to the buyers with certain restrictions. In third case, where there's a tax deferred reorganization, typically it is used when there is no boot involved and seller is continuing in the new business or the combined business of the buyer. So they can substantially continue with a value or with certain percentage, which requires under the law, so that a tax deferral treatment can be given. Meaning the immediate taxation of that can be deferred to the time when a real realization is happening at a future date. Next slide, please. Now, typically between the stock and acquisition, what really happens, and I think this would be one of the key and most important slide in terms of how typically an M&A works in a summarized manner. The stock acquisition, of course, it could be of a C Corp and S Corp. Now, S Corp, C Corp legally could remain a subsidiary of a company. However, with certain election, whether it can remain a subsidiary from a tax attributes perspective or not, could be completely different. Now, targets usually will carry the historical basis, which means that there is no step up available of fair market value at the price which you are paying for the targets. All the NOLs carryovers would be available subject to the restrictions there under Section 382 and 383. And of course, the buyer inherits all the liabilities, including tax, legal, commercial, and all the regulatory exposure, which is typically there in the stock acquisition. Now, this is how similarly, in Indian context also we look at it, right? How slum sale is there and a business transfer is there versus a sales tax. So I think from an audience perspective, it is equally important that it is looked into the similar manner. However, this election which is available in US tax, though not available certain elections in India, could change the distinction which are there between the buyer and asset acquisitions. So it could completely change that how stock acquisition would be looked into for buyer and seller, and similarly for asset acquisition. In India, it is straightforward that a slum sale will be a slum sale and it will be a business transfer from a both buyer and seller perspective. However, election could take place and probably could change the whole scenario. On the asset acquisition side, of course, the limitations are there. Difference only would be that no basis carry forward as such would be there because their step up would be available in case of asset acquisition with an election or a deemed asset acquisition in certain entity which you are acquiring, typically in case of partnership or a sole proprietorship. With an S corp, differently from what partnership and LLC is there, though they are also passed through, but S corp is technically not a legal entity as such, which means that it is an Inc. entity incorporated in US. However, it's an election required by certain qualified shareholders to treat an S corp, and hence, though it's a pass-through entity, but it could be also treated as an asset acquisition transaction if acquired only through certain elections. So the key benefits available in US under the asset acquisition is the asset amortization benefit, and that is also available for goodwill also. I think you heard me right that it is also available for goodwill. Typically, in any transaction looked into India, probably even a purchase goodwill may not get the benefit, and there are certain restrictions around it. However, in US, all intangibles, including your customer contracts or relationship or goodwill as well, along with that, you get a 15 years amortization period under the IRC 197. Next slide. Now, what are the preference when you go for a seller versus buyer? Now, me as a seller would always prefer a capital gain treatment. Meaning in US, there is a tax rate, concessional tax rate available for capital gain at 20%, which is of course a very good rate as compared to a maximum marginal rate, which is approximately at 35-37% for an individual taxpayer. So any seller would want that capital treatment as a seller. There's no double taxation. It's a stock sale. It's a straightforward preference for him. And at a clear certainty that he's getting the full exit. Whatever is there should not be taxed otherwise in any form of compensation or salary or a transaction amount, which could be paid in a later time. There is no recapture of depreciation risk, meaning if over the period of business, if a company or a target company has done certain depreciable assets, that is not subject to recapture if it is completely sold to a new buyer. So that risk is something, is there. However, seller preference is that it should not happen if it is a complete stock sale. C Corp, if they do an asset sell, then seller would have a double level of tax, one at entity level and then at a shareholder level. And the money would also get stuck in the corporates because the sales consideration would come into the target and then has to have a bear a cost at a shareholder level. Of course, the goal is, of course, to protect the net proceed from the double taxation and any recapture. So that's why seller preference would be that it's give me a capital gain treatment. On the buyer side, since they want a step up basis, that is only available in case of an asset purchase. The amortization benefit which is there or any asset depreciation which is available on the fresh fair market value, meaning as per the purchase price allocation, whatever is the value we have paid under the asset purchase, you get the step up basis and you get the amortization benefit or the depreciation on the entire asset block which we have purchased. It would be considered even under the OBA as a fresh asset purchase, and hence if there are bonus depreciation available, there are certain qualified property which bonus depreciations are also available, then those bonus depreciation would also be available on those assets, even though it's an old asset for somebody. But since me as a buyer purchasing it right away as an asset purchase transaction, then all those benefits would be available to me. And of course, under the stock purchase, we will get the carry forward benefits. It comes with a very restrictions under that because there's a change in ownership which is there. Hence, NOL, R&D credits, any tax attributes which is there will all be available to the buyer. However, it will be coming at a certain restrictions. So the buyer objective would be to maximize any post acquisition tax deduction which is available or any benefits which are available. He would like to maximize it as a target, as a buyer. Next slide, please. So largely, the buyer would have a immediate buyer and seller both would have an immediate tax consequences if it's a taxable transaction right away under section IRC 1001. Seller immediately recognize the gain and pay the capital gain tax. Buyer, of course, may get the step up basis and the amortization benefit won't be available as such. However, they will record this as an investment in their books. But if it's an asset purchase, they get the benefit of that. The related purchase price allocation needs to be done basis whatever the price has been agreed for each assets for which we are paying the price. And lastly, the benefits are more available for the certain intangibles and goodwill as well. Tax deferred reorganization would shift the burden of tax in a future date. The key thing to remember in a tax deferred reorganization is that it has to be treated as something which there is no boot involved, which means that any cash involved and there are certain dilution of existing shareholders of seller or target company, that would mean that it will be considered as a taxable transaction. So certain disqualification which may treat certain transaction as a tax free or a deferred transaction could trigger a taxable event and immediate taxation event may come. And there are certain elements which are available in case of taxable and asset acquisition as well. If there are deferred compensations involved, meaning that there's a contingent consideration is there or there is a earnout related payments is there as a part of the deal, then both under the stock purchase and asset purchase, the treatment would be accordingly there when the asset value is realized. So in case of an asset purchase, when I am paying the target or the seller 2 years later for certain earnouts condition being met, then that deferral would be there for those particular amounts paid 2 years later. So all the benefits related to that extra amount which I'm paying 2 years later, any goodwill arises out of that, those tax benefits or those amortization benefit would be available to the buyer under the asset sale only after the 2 years. So I think these are the key things, and as a summarization, but I think I'll pass on to my colleague Shrenik to have a more technical discussion how reorganization works and how certain election could treat stock purchase and an asset purchase. Over to you, Shrenik.
Thanks, Shashank, for perfectly laying out the ground for me. Hi, everyone. Good evening. So we'll be discussing mainly two sections, IRC 360F reorg and IRC 338H10 election. Next slide, please. So before we begin, so just to give you a context, IRC 368 deals with the tax-free reorganization in a various manner. We are going to conduct a separate webinar on this section specifically to discuss how each of this tax-free reorganization works. But just for your quick background, we have given it on the screen on typically it is known as type A, type B, C, D, and E. So these are some of the tax-free reorganization which can be conducted by the organizations in the US. And for right now, our focus will be on the F reorg, which we'll be discussing now. Next slide, please. Yes. So F reorg. So F reorg is typically done before the pre-sale. So any M&A activity, technically, if you want to buy an entity in the US, want to do an asset acquisition, then this F reorg is done before the transaction happens. So what does it mean is that it's purely changing the company's or the corporation's legal form while everything remains the same under the business owners, etc. Everything has to be there, and that's their key requirement, that it has to be a mere change in the identity, legal form, or place of organization. So it should not change the hands, it should not have any cash consideration, the business, etc. operation should remain the same. And this reorganization is typically done to make an entity from an INC to an LLC. That is the key reason this whole exercise of an F reorg is done, and it is popular. It is very popular in the US. We'll discuss how this whole works, but this is more of a requirement. Ultimately, the outcome is that we would want to do the tax-free reorganization and then want to buy an entity so that we can treat this transaction as an asset acquisition for the tax purpose. The underlying from the legal perspective, it may be still an stock acquisition, but for tax purpose, this will be treated as an asset acquisition. That is what the benefit which we are going to talk about. Next slide, please. Yeah. So before we begin, so just assume you as an audience, you are a C corporation who is a buyer, and there is an entity which is with the historic owners who are the US persons, individual owners owning one ABC INC, which is an S corporation. So just go along with this and probably will be able to get more idea about it. So this historic owners incorporate one entity called a new company, and there is already one existing entity, ABC INC. The owners do the S corp election for this new entity also, and then there are two entities. One is the ABC and one is the new co for that matter. Now, in the next step, the owners will transfer the interest of ABC INC into the new co to make it a subsidiary of the new co. So ideally, now there is one S corp. Now then there is two S corp, parent and a subsidiary. So they will do the qualified subchapter S election for the ABC INC. So ideally, this election can be made when your parent is also an S corp. So that will be ideally the step number 2, wherein you are treating this ABC INC as a subsidiary of the new company. Next slide, please. Yeah, so this is how the structure will look like. So now there is a historic owner who owns the new co, then who owns the ultimately ABC INC, which is a qualified subchapter S. So and after the completion of step 2, your structure will come to this picture. Yeah, next slide, please. Yeah, so this is one of the most important slide in this whole presentation. So ultimately, this step 3 and step 4 are going to be the important part. This you can see that now the ABC INC has been converted to LLC. So the step 3 is converting this ABC INC, all the assets, all intangible, everything is under this INC. So the next step is to convert this INC to an LLC, and it is very common in the US to convert this status from INC to an LLC. And why does it matter that now when in the US, when LLC is owned by a single person, it is treated as a disregarded entity for the tax purpose. So now after this conversion, this disregarded entity will be the owner of this disregarded entity will be a new company which is owning 100%. The next step, this is where sort of the whole, just please be on the previous slide only. Yeah. So the next step 4 is about adopting the plan of liquidation for the ABC LLC. I want to highlight this is a plan of liquidation. This is not an actual liquidation. So, and also I've specifically mentioned that this is one day after the conversion, but one day before the sale, this is happening. So this is from a completeness perspective in case of an IRS audit, that in case we can prove that this entity, we intended to liquidate it, and that is why this plan of liquidation was adopted. So ideally, we are saying that ABC INC has met the purpose, and we will be merging this all the assets into new co. We are not doing it. Is it just a plan yet? So this is where officially the 368F reorg sort of is completed. And this whole exercise which we talked about until now was to arrive at this step, that we wanted this ABC LLC to be treated as a disregarded entity for tax purpose. Next slide, please. Yeah, this is where you come in, that now you as a buyer will say that, hey, hey, new company, I want to buy all the units of the ABC LLC, and against which I will give you the promissory note. So this is where the buyer will sign an agreement to purchase this ABC LLC. Why does it matter? Because the ABC LLC is a disregarded entity, and as per the US tax law, if you are acquiring an disregarded entity, then it will be by default treated as an asset acquisition for tax purpose under revenue ruling 995996. My colleague Prathamesh will talk about this in detail, but this whole exercise was done to arrive at this situation. So In this promissory note, they are saying that we will pay you for acquiring this entity, and this is what is going to be the main sale transaction where you are entering into the agreement. Next slide, please. So yeah, so your new company is distributing the note to the historic owners, and then you are paying the money, the proceeds to the historic owner. Alternatively, we have seen that this distribution of the promissory note is not done to the historic owners, and ultimately the money has been paid to the new co, and then new co distributing it to the historic owner. So both the structures are prevalent, and it is we have seen both the structures which is happening. So either of them is the fine. This depends on also if there are earn-out considerations or not, and whether you would want to make the payment to the new co from the legal perspective as well. So both the structures are okay, but we have seen that if you would want to make the payment to new co and then they distribute it, it should be fine. Next step. Yeah. So the last step of the 368F reorg, wherein if it's a one-shot payment, want the sellers to keep this new co until the last penny has been given out. You may ask them to keep this new co for that matter. So uh, uh, the last step is to liquidate and make the payment on the earn out in the future if there are any certain conditions which are attached to the agreement. Yeah, so this is how the whole 368F reorg will work, which will allow you to convert this entity LLC into LLC, and then ultimately have an asset acquisition. So the underlying point was that this was an S corporation which was treated as an LLC, and then it was done an asset acquisition. Yeah, next slide, please. Yeah, so points of consideration. So I think if you recollect, until point 4, there was a continuity of ownership, there was the business, etc., was the same, there was no change in the business. And the important point in this slide is going to be about the S corp election. So from our experience, we have seen that the S corp election at federal level is done very prominently, but we have seen that there are many states who ask you to do the election at the state level also, but that has been completely missed. And for that reason, at federal level it may be an S corp, but at state level it can be a C corp. So it is important that before you do this whole exercise, this S corp validity has been checked, so that whenever this transaction happens, and this transaction does not become irrelevant because of such invalidity of the election. So please make sure that you do all this verification, and also this conversion and the merger, all the documents also you need to keep it, because when you are when if in future there is any IRS audit, etc., then technically they may ask for all this documentation. Transaction risks and tax attribute will be covering in the next few slides. Next slide, please. Yeah. So this is also one of the prominent election which is available, which is called as IRC 338H10. So this is also one more tool to make the stock sale into a deemed asset sale. So what it means is that legally it can be a stock sale, but for tax purpose it is still an asset sale. So this is a benefit which is sort of given wherein it's a joint election. So both seller and buyer has to agree to make this election. Eligibility requirements that you should be a corporation. The target entity has to be a S corporation or a subsidiary of a consolidated group. So this is the requirement. And third requirement is to acquire more than 80% of their ownership in the period of 12 months. So these are the sort of key 3 eligibility requirements wherein you can make this election with them. Individuals and partnership cannot make it. Ultimately, the outcome is what we are looking at is to make this transaction as an asset acquisition for tax purpose, whereas the underlying is still stock acquisition. Next slide, please. Yeah, so the steps will be that first, of course, confirm that the target is an eligible target. What I talk about the S corp validity, all that. Then make an more than 80% of the purchase of those shares, then make a joint election. So there is a form which needs to be filed with the IRS, so wherein that both parties are agreeing to make this election. Also, your SPA, which you are signing, also should cover all these aspects, that this election will be filed by both, and any future requirements, etc., on the form filing with the returns, etc., will also be complied by both the parties. Ultimate result is the deemed asset sale, which will happen, and it will be the last step will be the deemed liquidation. Next slide, please. Yeah, so points for consideration. So 80% is bare minimum, which is required. The compliance requirement will be there. Gross up request can be, so negotiation points. So seller may, if it's a tangible heavy entity, then their assets, the sellers may ask you to give you certain additional consideration, because this election may be detrimental to the sellers, because there may be certain additional cash outflow, which my colleague Shashank slightly mentioned about that. There can be stock. They may say that we want to do a stock sale, and we said sale is not beneficial for that. But you as a buyer say that, okay, hey, we will give you the whatever the additional tax cost which you are incurring because of this election as a gross up, because net you may still may be in a benefit, and this negotiation point may come up by their lawyers, and they may ask for this additional consideration. So there is a detailed calculation which is generally done. If it's an intangible heavy, generally it does not make major difference, but if it's a tangible entity, there is a depreciation recapture which needs to be looked at it. Buyer, of course, gets the step-up basis for all the tangible and intangible assets which you are acquiring. Next slide, please. Yeah. So just to summarize on this, both the aspects, so 368 versus 338 H10. So here we saw that 338 H10 had 80% only requirement, whereas here, if you want to acquire, there is 100% acquisition which you need to do to make it an asset acquisition. Then there were certain business requirements about that the owner should sort of continue. The S corp election has to be there. So that all sort of requirements, those were there in the 368 F reorg, that it has to be only mere change of identity, etc., and you are not required to do all that in the 338 H10. So if you ask me which one is much more beneficial, then we have seen that 368 F reorg slightly has been beneficial for the buyers because of certain calculation perspective, which I'm not going into much detail right now. But both these sections are very much relevant to make the transaction as an asset acquisition, and I would highly recommend you to go through this section and this elections to make the transaction extremely effective from that tax perspective. With this, I'll pass on the baton to my colleague Prathamesh to take us through the rest of the webinar. Thank you.
Yeah, thanks, Shrenik, for the valuable insights and actually setting up the context for the next important topic that we'll be discussing, the deemed asset acquisition rules. So we'll first start or begin with the revenue ruling 99-6. The ruling is particularly relevant where a domestic limited liability company, which is classified as a partnership for US tax purposes, and one person acquires all the outstanding ownership interests in that LLC. Legally, the buyer is purchasing the equity interest in the LLC. However, for tax purposes, the treatment differs for the seller as well as for the buyer. The seller or the partner is treated as if selling the membership interest in the LLC, ultimately resulting in a capital gain or loss for the seller, with one important exception. If there are any hot assets such as unrealized receivables or inventory items, then the gain attributable to those assets can be classified as ordinary income. Whereas what's important over here is from a buyer's perspective. As and when, from the two partners, the partnership changes hands to a single buyer, the partnership terminates and it again becomes a disregarded entity. Hence, the buyer is treated as if the buyer has purchased all the assets from the partnership and in a way gets a stepped up basis in the assets of the partnership, resulting in the future higher amortization and deduction for US tax purposes. In a way, we are able to maintain the legal status of it as a stock acquisition, thereby allowing us to retain the customer contracts, employment contracts. Whereas for tax purposes, we get a step-up basis from a buyer perspective. Moving over from a revenue ruling 99.6, we go to the next code section, which is a section 338G. It is again a corporate election available to the purchaser who is a corporation. The important requirement is that the selling entity should be, or the purchasing entity should acquire more than 80% of the stock of the target corporation within a period of a 12-month period. Now, this is a unilateral election that can be made by the buyer alone. So that's an advantage as compared to the 338H10 election, where that needs to be negotiated with the seller. However, said that a form, there are requirements to it. The form 8023 needs to be filed by the buyer entity in order to have this transaction effected. Said that it's a unilateral election, the tax consequences are much complicated over here. So moving on to the next slide, where we will be discussing the tax consequences of the 338G election. Yeah. If we can go to the next slide, please. Perfect. So as you can see, what happens is that the old target entity is treated as if it sold all its assets at an aggregated deemed sale price. Hence, there is an entity level taxation that arises at the target entity level. At the same time, the seller also needs to pay taxes as if it has sold the stock of the target entity. So thereby resulting into the two levels of taxation, one at the target entity level and one at the seller level, thereby kind of creating a significant tax exposure at the time of deal itself. However, when this can still be beneficial? This can be beneficial in the situations where the target entity has huge losses, wherein which we can use these losses to utilize or to offset the gain arising on the deemed asset sale at the target entity level. This can also be beneficial in case the corporation is a foreign corporation, the target entity, wherein the gain arising on the deemed sale of assets is not subject to US taxation due to ECI rules. But we also need to be mindful here about the international tax rules, especially about the guilty region. So in these two situations where the target entity has huge losses, or if the target entity is a foreign corporation, 338G election can generally be a better placed. What benefit it gives from a buyer perspective? Obviously, we get a step up basis as a deemed asset purchase and resulting into a future higher amortization and depreciation for the tax purposes. Now, moving over from a Section 338G election to the one final regulation, which is a Section 336E election. 336E election is kind of common or similar to the Section 338H10 election or 338G election that we discussed, with one important exception. In both these elections previously discussed, the one important criteria was that the purchaser needs to be a corporation. However, 336 does not have such requirement. Hence, 336E helps in a situation where the purchaser is a private equity, individual, or a partnership, or purchases through any non-corporate acquisition vehicle. The eligibility requirements are similar. There has to be kind of a sale of more than 80% of the stock of the target within a 12-month period. We need to do the elections. An important point, this is also a bilateral election similar to 338H10 as Shrenik had explained. Now, this is generally beneficial in two situations where the S corporation is getting sold to an individual or to a private equity, or where a domestic corporation with a US corporate parent is being sold again to a US individual or to a private equity as such, ultimately resulting into the same benefits. Legally, we are still acquiring the stock, but for tax purposes, the buyer gets a stepped up basis over here. From a seller side, again, there will be a two level. There can be a two level of taxation: one on the sale of the assets of the target, and then thereby, as if the target liquidated, resulting into a capital gain upon the liquidation of target into the sellers. So overall, in all these three situations, what we covered, one important point to note is that this is generally preferred when a pure asset acquisition can't be done, because we need to retain the customer contracts, employment contracts, or various other licenses at the entity level. But still, for a tax purposes, we need to have a step-up basis from a buyer person. Now, with this, we move to the next important element, which is a transaction risk. Determining a right structure or which election to be made is just the first step of it. But what also needs to be keep in mind is that we need to secure ourselves from all the transaction risk, different parameters that can come into the play at a later state of time. The first important criteria is in a 368 reorganization. So as Shrenik explained, there are various reorganizations that can be done to effect the acquisition. 368 statutory mergers are one of the most common one. However, just because we do something legally, it does not mean it's a foolproof reorganization from a tax person. There are many important conditions such as continuity of interest, continuity of business requirement, valid business purpose. At times, solvency requirement also needs to be evaluated. So it's very important to see that all these requirements have been satisfied. Otherwise, you may do a certain reorganization, keeping in mind that it's a tax-free reorganization, but eventually it turns out to be a taxable transaction, then the tax outcomes could be far worse than doing a pure stock sale as well. Now, the second important point is that the past liabilities, which we generally undertake in a stock transaction. And this past liabilities can be inherited even if you do a deemed asset acquisition as well, because legally you're still doing a stock acquisition. So in this situations, what happens is that the past liabilities of the target, any unpaid federal state tax liabilities, any unfiled exposures, sales and use tax liabilities, any issues with their ESOP plans from a 409A compliance perspective, all that can be passed on to the buyer because we are, kind of purchasing the stock. Just because we purchase the stock, all the associated liabilities with the target does not disappear overnight. Hence, in order to avoid inherited liabilities, people at times prefer pure asset acquisition as well. But over there, then the second question comes how to transfer the customer contracts, licenses, and so forth. So all things needs to be balanced. Next point is section 382 NOL limitation. Shashank and Shrenik briefly touched on this. So whenever the target entity shifts hands from one person to the another person, the tax attributes also get carried over from one person to then another person. However, it imposes certain limitation known as section 382 limitation. The target entity may have a huge set of NOLs, but what is important is that how much NOLs I can use as a buyer. So section 382 imposes limit on it. It kind of imposes limit based upon what's the fair value or the purchase consideration at which the entity was acquired multiplied by the AFR rate which is published by the IRS. There are certain concept of realized built-in gain which can help you, to accelerate the utilization of the losses for the first 5 years as well. But that needs a detailed and a thorough evaluation. The important point to note over here is that as a buyer, when we are purchasing the entity with the huge losses, you should not directly allocate entire value to the NOLs upfront. You should see what's the present value of that NOLs, how much it will be of a benefit to you. You may purchase an NOLs of $100 million, but let's say if every year you're able to use only $2 million, then what's the use of it? In terms of, rather than say what's the use of it, the utilization will be very slow for you. And in terms of the present value or the real value will be minimal over there. Hence, 382 is a very important consideration that should be kept in mind. Moving on to a depreciation recapture risk. So similar to the section 751 hot assets that we discussed, even if let's say in terms of an asset sale, if certain value is allocable to a fixed assets, especially which are highly depreciated, then to the extent of the depreciation amount that is getting recaptured, the gain is generally classified as an ordinary income. So this is a small point that should be kept in mind by the sellers who have a huge fixed asset space with them, but who may have claimed a bonus depreciation and return of those assets for tax purposes. And the next important point is double taxation for C corporation sellers. In case of a C corporation, if you are planning to do an asset sale, then be ready for a double taxation. Because what happens is that first, the C corporation will need to pay tax on the sale of an assets. And then second, once the C corporation liquidates, assuming if the seller is a US person, the US person also needs to pay taxes on it as a capital gain. Now, if the buyer is insisting for an asset acquisition or a deemed asset sale, as a seller, our responsibility is that we should ask for a tax gross up. That's a more about a point of a negotiation. We should ask for an additional purchase consideration because we are, kind of bearing the additional risk or an additional tax exposure of undertaking the transaction as an asset sale. From a buyer perspective, we should evaluate, whether the tax gross up that is being demanded by the seller is less as compared to the what benefit or the present value of benefit I'm going to receive over the next future years through a higher depreciation and amortization on the stepped up assets. Now moving on to the last point and a very important one, section 7874 anti-inversion rules. Now this is something that you will have heard very commonly over the last couple of years, which is commonly, people are referring to as a reverse flip as well, coming back to India from US or from Singapore. But US has its own different set of rules from a section 7874 perspective. We will be, conducting a complete separate webinar on this topic. But just to give an insights, whenever a foreign entity acquires a stock of a US corporation wherein the old shareholders of the US corporation continue to hold stock in the foreign entity, then it is called as an inversion from a US tax per se. And IRS have set up very, very strict rules for this. If your inversion falls into the criteria of an 80% inversion, wherein the old shareholders of the US corporation continue to own more than 80% of the acquiring foreign corporation, then the foreign corporation for all US tax purposes will be considered as a US corporation on a going forward basis. And 7874 is a very important concept that needs to be mined and evaluated, especially when there is a foreign entity which is acquiring the US corporation. With this, I'll end up on the transaction risk and hand it over back to Shashank, to provide his practical insights based on his experience over the years in the deal segment.
Thanks, Prashmesh. Thanks, Shrenik, for the overview and explaining us the concept. Please, next slide, please. So I think we've discussed about the elections which are available. Whatever is the standard stock purchase or whatever the standard asset purchase is there, that is available and straightforward. But I think what is important that what is the type of entity of the target? The very first question somebody should ask is what is the type of entity? Because certain elections, revenue procedures, which Shrenik and Pratmesh touched upon, that is only possible basis the type of entity you are acquiring. For example, very specific 338S10 is available only if the target is an S corp and not for otherwise. 99-6 procedure is only available when there's a partnership or an LLC, and it is naturally possible because it is deemed understand that if I'm targeting a company which is a partnership from a tax perspective, I'm not buying the partnership, but I'm buying the asset from the partners of the partnership. And hence, legally, I can buy the assets from a legal person. Artificially, I can buy the stock of a company and treat it otherwise. However, from a partnership, an LLC, or a sole proprietor for that matter, I can buy the business from those individuals rather than those entity itself. So I think these elections are important and how this tax classification changes. So it depends on what kind of transactions you're looking, and it depends on how election can make the tax consequence, the future post-tax closing benefits. And lastly, of course, if there are any reorganization pre-sale we can be doing by doing the 368A1F reorg so that we can do a better tax planning. Next slide, please. The key drivers today, we look at is basis my experience is the basis step up. Now, largely any tech companies, if we have seen and dealt with, largely we are buying the intangibles. It's typically are the customer contracts and the goodwill of the company. There is say a $30 million of an acquisition, but with only 1 million tangible benefits. So entirely 29 million is intangible identified during the acquisition. Entirely 29 million is available to me over the period of 15 years to amortize. And that's why any buyer from that perspective is willing to do a assets purchase for that matter, or at least those elections are available. That's why those buyers are finding the targets on which this eligible election can be made without any double taxation events. Of course, on the OBA, 100% bonus depreciation has brought back, and that's why all the tangible assets which are available, I can get them the asset benefit immediately from day one and amortize it over basis the cycle of the life of the assets. Net operating loss, key consideration again, because usually the transactions value are high, and even if the limitation applies, may be able to utilize the entire losses limitation. But of course, it's very important that what kind of losses and what kind of limitations applies basis the transaction value. Overall, tax-free reorganization should be looked at if at all we are not doing a complete target acquisition. If we want to continue seller and its shareholding and it's a partial acquisition, I think the tax-free reorganization is very important, especially statutory merger and the 368A1F reorgs or any other reorganization which suits the old situation of buyer and seller both. And lastly, we have to keep in mind that the capital gain treatment. I think it's very important that seller would want this treatment for better certainty in future. There's no future litigations for the seller perspective. The deal and done closed, but there's no future consequences as such on those parts. Lastly, I would like to close with the fact that with the 4 steps, if you are having any structure, first, you have to identify the type of entity you are acquiring. In India, we may have a straightforward answer that, okay, what kind of asset purchase or a stock purchase I need to do. But in US, you have to also see that what type of entity you are acquiring because that completely changes the tax benefits. Of course, the priorities of both buyers and sellers, because valuation can be decided within a week's time. But I have seen practically that closing on the right structure takes about 4 weeks to 6 weeks also. So valuation 1 week, but takes about, say, can be closer faster, but defining a tax structure, because seller would want extra penny for that from from the buyer. Third, select the right structure once the economically alignments are done. And lastly, model the tax economics, whether the right targets can be selected after comparing what kind of tax benefit is available, what kind of tax consequences immediately happening, and also what kind of tax benefit is available post tax benefit. And I think, as Prasmit highlighted, we need to see the present value. It's not just that you need to see what value you are having today, because economically you don't know that 10 years whether you are surviving or not. So the tax benefit need to look at what present value you are arriving at. With all these four framework, one can decide what kind of acquisition. But at the last, what I want to say is that it's not definite that what is the right structure always, whether an asset or stock, but there's no definitive answer. Always it is about the priorities, how buyer and seller looks at it at the deal closure. So I'll hand over for the Q&A. I think we are about time. But if there are any questions in the block, I think we can take some of them, or rather, uh, we can also take it and send you an answer post this session in a day's time. I think we're about time. So I'll leave Amrita to you, and Cherry for closing comments. Thank you.
No, thank you so much, Shashank, Shrenik, and Prathamesh, for that wonderful and such a detailed knowledge about every topic. And I believe most of the questions have been already answered. But if there are any in particular that you feel that, that should be, should be answered, or something that people are not thinking, but something that they should kind of, be keeping in mind. So if there's anything that you would like to add, if each one of you can add one important something that, these each attendee, especially when working on the, or especially on the navigating aspect. So if you, I mean, that would be really helpful.
Sure. I think one thing, we have closed recently, one of the clients and deal we closed about $35 million was a small deal. And I think what is happening with the election is something, a perspective changes from a financial reporting perspective.
Mm-hmm.
Because all the tax auditor, from an audit perspective, the things to get closed, how elections are made at India level, consolidation level. I think the key important thing is that even though your acquisition is a stock transaction, but you're electing to be treated an asset purchase transaction, your
Mm-hmm.
opening balance sheet, your deferred tax balances can change basis the election you are making, and that needs to be decided on the day of the deal, because the seller
Okay.
also has to agree on the basis of the assets. So it's not like I can decide 4 5 months later, but today itself when I'm
Okay.
closing. So I think the tax basis is very important to log from a deferred tax and financial reporting perspective. Usually it's uncommon, but from a US tax perspective, it's possible that you can have a investment in subsidiaries showing in your balance sheet, yet you can
Mm-hmm.
have an asset purchase treatment from a tax perspective, and it could change your deferred taxes. So
Interesting.
I think that's something very important. I have seen that still we are dealing on the purchase price allocation. Anything
Mm-hmm.
Shrenik and Prathamesh you want to cover, touch upon?
So I'll just give the closing comment. I think from my experience, I think when this elections wherein the stock acquisition is treated as asset acquisition for tax purpose, one of the key negotiation part is on the gross up of the purchase, because stock sale is always the preferable option for the sellers versus the buyer want to have an asset
Mm-hmm.
acquisition, and that is the reason um, seller may say that, hey, I'm incurring this additional tax because of you, so you pay me up to do that.
Mm-hmm.
That is where this negotiation, calculations, discussions, what mentioned, Sashank mentioned about the value of the assets, which for that calculation purpose. So that may eat up the time of the deal, whereas you never anticipated that this will be a problem for you. So it is
Mm-hmm.
important that this discussions have start at the right of the deal, and then accordingly all the numbers are locked during
Right.
the deal as deal only. So yeah, that's all from my side.
Prathamesh, if we can have your
Yes.
views also.
Just the final thing is that, don't think about the tax structuring at the end of the day. Think it from day
Mm-hmm.
one, when you're signing that letter of intent itself. Start planning about it, how you want to structure the transaction. The more you postpone, the less opportunities you have to structure it. The better you plan it in advance, the more opportunities you will have to structure it in a more tax efficient manner so that you can look at things from a holistic view. So that's a simple advice from my end.
And that's a very interesting point that you mentioned, Prathamesh, that is don't wait till the last moment.
Yeah.
Start thinking about it right from the beginning. And I believe that's one thing that all the three speakers have mentioned. And that is something I think we all need to understand, that everything has got its correct time and the proper procedure. It's whether it is cross-border, whether it is within the nation itself, or whether it is internal, or you're dealing in different organizations at different countries also. So thank you so much, Shrenik, Shashank, and Prathamesh, for your time, and of course the entire team of Grant Thornton Bharat, who has been supportive with us for this entire, for this the entire curation of this wonderful topic. And as you all mentioned, that there are a few things where you will be hosting a separate webinar, because there are a few topics which need further more elaboration. So I'm sure our audience would be waiting for those. So I believe our job is now next to start working on those, right? So, which is interesting. So, I would like to say thank you. My chairman had to drop out because of some sudden, call had come. So, on behalf of IACC and all the attendees, I would like to give my heartfelt thank you to all of y'all, and thank you so much for joining us and for sharing your views and all. And we hope today's discussion has provided valuable insights into US mergers and acquisitions, transaction structures to the attendees, and also the tax considerations that drive successful cross-border acquisitions. Well, it was definitely a lot of learning for me, because coming from Indo-American Chamber of Commerce, it kind of gave me a lot of input and insights, which I think I can help further to my members. And if in case there are still any questions that if the attendees have, please do write to us, and we will definitely make sure that your questions reaches the speakers and they are answered. So once again, thank you so much everybody for joining, and thank you so much Shrenik, Shashank, and Prathamesh for your
Thank you.
time. Thank you so
Thank you
much.
for having us.
Thank you.
Thank
Thank
you. Thank
you.
you everyone for joining.